Hello everyone, I'm Zara Fatima. Welcome back to my channel. Today in this video I'm going to explain you the subject cost control and management accounting. Under that the topic is marginal costing. The subject cost control and management accounting is for the students of BCom third year semester 6 students. And the topic marginal costing is also having by the students of MBA semester 1. So this video is useful for MBA students as well as BCom students. And so far we have completed 9 problems on the topic marginal costing. Alhamdulillah. Now in this video I am going to explain you one more question of the topic marginal costing, and this question is very important from your examination point of view. And students, in my videos presently I am covering only those questions which are very important from your examination point of view, because you have examination very shortly. So I am trying to explain you those questions which are very important from your examination point of view. And today's question is also very important. Now let's see the question. The question is, the sales, turnover and profit of a company during 2 years was as follows. And information is given: sales, profit, year 1991, 1992. Sales are 1,50,000, 1,70,000. Profit is 20,000 and 25,000. You are required to calculate PV ratio, break-even point. Sales required to earn a profit of 40,000, that is desired profit, and profit made when sales are 2,50,000. Margin of safety at a profit of 50,000. Variable cost of 2 periods. So students, this question is 2 period question. 2 years information is given. 1991 and 1992, 2 years are given, and sales for 1991 is 1,50,000, for 1992 it is 1,70,000, and the profit is 20,000 and 25,000. So 2 years information is given in the question. So this is the problem of 2 years or 2 periods. So in the question, sales is given and profit is given for 2 periods, and he is asking you to calculate different questions: PV ratio, break-even point, sales required to earn a desired profit. Okay. Now for calculating PV ratio, for calculating break-even point, sales required to earn a profit, first we make a statement, and under that statement we make 2 columns. In first column we have taken year 1991 and 1992. The second column is sales, which is given the question. For 1991 the sales is 1,50,000, for 1992 the sales is 1,70,000, and sales is represent S. And profit is given for 1991 profit is 20,000, for 1992 profit is 25,000. This 2 information is given in the question. And the last column is total cost. In my previous videos I explain you the marginal equation. Marginal equation, S is equal to V plus F plus P. So in the question, sales is given, that is S, and the profit is given, that is P. If we subtract profit from the sales, we get total cost. Total cost consists of variable cost and fixed cost. So sales minus profit, S minus P, we get V plus F, that represents total cost. So 1,50,000 minus 20,000. So the total cost is 1,30,000. This 1,30,000 consists of variable cost as well as fixed cost. Now second year the sales is 1,70,000 and profit is 25,000. So 1,70,000 minus 25,000, the total cost is 1,45,000. Now we have to take the change. change of sales, change of profit and change of total cost. So how we can take change? From 1992 subtract the values of 1991. So 1,70,000 minus 1,50,000, the difference is 20,000. The change in sales is 20,000. 25,000 profit 1992 and in 1991 it is 20,000. So 25,000 minus 20,000, difference is 5,000. Now from the total cost 1,45,000 in second year, subtract the total cost of 1991, that is 1,30,000. Difference is 15,000. Now we get the change. Change of sales 20,000, change of profit 5,000, change of cost is 15,000. Now in the question is asking you to find out the PV ratio. Now for finding the PV ratio we have a formula, that is contribution by sales, and one more formula is there, that is change in profit by change in sale. So change in profit by change in sale, that formula we applied when two periods information is given. So now in this question for PV ratio, formula is change in profit by change in sales into 100. Change in profit is 5,000, change in sales is 20,000. So 5,000 by 20,000 into 100, we get the PV ratio at 25%. Change in profit by change in sales, that is 25%. Now next bit is asking you to find out the break-even point. For finding out the break-even point, the formula is fixed cost into sales by sales minus variable cost, or you can find break-even point by applying the formula fixed cost by PV ratio. So for finding the fixed cost, first we have to find the variable cost, because in my previous videos I explained you what is variable cost and what is fixed cost. Fixed cost, the cost which remains constant. Variable cost, the cost which fluctuates, which varies, which change with the change in level, with the change in sales. If sales are changed, variable cost also change. So here first we have to find the variable cost for finding out the fixed cost. So how we can find variable cost? Here change in sales is 20,000 and change in cost is 15,000. The change in cost is nothing change in variable cost, because fixed cost will not change. This change comes in only variable cost. So this 15,000 is the variable cost for a sale of 20,000. So for a sale of 20,000, the variable cost is 15,000. Now we can easily find variable cost for a sale of 1,50,000, 1991 sale. So here for a sale of 20,000, variable cost is 15,000. For a sale of 1,50,000, variable cost how much? So 1,50,000 into 15,000 divided by 20,000, we get a variable cost 1,12,500. So this is the variable cost. Now we have total cost. Total cost consists of variable cost as well as fixed cost. From the total cost, if we subtract the variable cost, the remaining part is the fixed cost. So fixed cost, total cost minus variable cost. Total cost of 1991 is 1,30,000. From this 1,30,000, subtract the variable cost. Just now we find the variable cost 1,12,500. So the fixed cost is 17,500. Now we have the variable cost, we have the fixed cost, and we have the sales. So easily we can substitute in the formula fixed cost into sales by sales minus variable cost. Fixed cost 17,500. Sales first year 1,50,000. 1,50,000 minus variable cost 1,12,500. So the break-even point in rupees is 70,000. So break-even point in rupees is nothing but break-even sales. So two bits we completed. Now the next point he is asking you to calculate sales required to earn a profit of 40,000. 40,000 is the desired profit. So sales required to earn a desired profit, for that formula is fixed cost plus desired profit divided by sales minus variable cost whole into sales. So fixed cost is 17,500, just now we find out, and desired profit is 40,000. So fixed cost plus desired profit divided by sales minus variable cost whole into sales. Fixed cost 17,500, variable desired profit 40,000, sales 1991 is 1,50,000 minus variable cost of 1991 is 1,12,500 into sales 1,50,000. We get the answer 2,30,000. Sales required to earn a desired profit 40,000 is 2,30,000. Now the next bit is asking you to find the profit when sales are 2,50,000. Is asking you to find the profit when sales are 2,50,000. So students, whenever in the question he is asking you to find the profit, find the variable cost, find the fixed cost, in that case we substitute in the equation. The equation is S is equal to V plus F plus P. Here we have to find the P, profit. So for finding the profit from the sales, subtract the variable cost, subtract the fixed cost, we get the profit. And in the question, the sale is 2,50,000. He is asking you to find the profit for a sale of 2,50,000. So sale is 2,50,000, and when sale is changed, variable cost is also changed, because in the information sale first year is 1,50,000. So for a sale of 1,50,000, our variable cost is 1,12,500. So whenever sale is changed, variable cost is also changed. So first we have to find the variable cost for a sale of 2,50,000. So here we have done the working. For a sale of 1,50,000, variable cost is 1,12,500. For a sale of 2,50,000, variable cost how much? So for a sale of 2,50,000, the variable cost is 1,87,500. And remember students, fixed cost will not be changed if there is any change in the sales. Fixed cost will remain constant, and our fixed cost is 17,500. 17,500. So variable cost 1,87,500, fixed cost 17,500. So from the sales, subtract the variable cost, subtract the fixed cost, we get the profit, that is 45,000. Debit is completed. Now EBIT, margin of safety at a profit of 50,000. He is asking you to find the margin of safety for a given profit of 50,000. So formula of margin of safety is profit by PV ratio. The given profit is 50,000. So 50,000 and PV ratio we find out here 25%. So 50,000 divided by 25%, the margin of safety is 2 lakh. Now the last bit is variable cost of 2 periods. So variable cost of 2 periods. Here first period is 1991, second is 1992. 1991, 1992. For 1991, already we find the variable cost, that is 1,12,500. So 1991 variable cost is 1,12,500. For 1992, we have to find the variable cost. So for a sale of 1,50,000, 1991 sale, the variable cost is 1,12,500. So for a sale of 1,70,000, second year sale, variable cost how much? So 1,70,000 into 1,12,500 divided by 1,50,000. The variable cost is 1,27,500 for 1992. So the variable cost for first year 1991, first period is 1,12,500, and for the second year 1992 it is 1,27,500. So variable cost of 2 periods. So with this we complete this question, and students, this question is very important from your examination point of view. If you like the video, then give a like, and if you not subscribe my channel, then subscribe the channel so that my future notifications related to my future videos will come to you directly. And share this video with all your friends and in your WhatsApp group. And very soon I am going to upload some more videos related to the subject Business Statistics 2 and Income Tax. And one more important announcement for the students of MBA semester 2. Very soon I am going to upload the videos for the subject Financial Management and Operation Research. So students, stay connected with us, like and share our videos, and subscribe the channel. Thanks for watching the video.